Welcome to today's Explainer. We are diving deep into a seriously high-stakes operational challenge today, decoding exactly how non-resident entrepreneurs can actually bypass legacy barriers to access closed US dollar financial ecosystems. We're going to strip away all that surface-level marketing noise and focus purely on the underlying infrastructure. We're talking about the nuts and bolts, the mechanisms and cause and effect relationships that literally dictate whether your global corporate setup thrives or whether you just end up facing frozen capital and massive compliance nightmares. All right, let's dive right in. Here is our roadmap for today. We're going to cover the structural problem, the mechanism of access, categorization and optimization, evaluating the proxy risk, and finally, we'll wrap up with global transfer architecture. Let's kick things off with part one, the structural problem. To really understand the solution, we've got to look at the main friction point. So how do non-residents actually access these closed financial ecosystems when they don't have a physical presence or a domestic personal tax ID? I mean, for decades, this was just a hard stop, no way around it. But we need to understand why that is. It's not just that legacy systems are stubborn, it's that they are fundamentally built on geographic risk models. The implicit assumption baked into legacy banking is that you live exactly where you bank. Their whole compliance structure relies on physical KYC, know your customer protocols, and domestic credit footprints just to verify who you are. If you don't fit into that rigid geographic box, the system just automatically rejects you.
And when you look at it, the divide is incredibly stark. On one side, we've got legacy banking requirements demanding you show up in person with a domestic tax ID. It's a completely outdated model built for a pre-internet world. But on the flip side, we have modern infrastructure, remote digital access. This operates 100% remotely and totally bypasses the need for a personal domestic tax ID. Now, how is that possible? Well, it's not some sneaky legal loophole. This modern solution relies on alternative digital verification and really sophisticated biometric compliance checks that completely replace having to walk into a physical branch. It's a technological bridge. So understanding exactly how we cross that bridge from the restricted side to the unlocked side is absolutely crucial.
Okay, moving right along to part two, the mechanism of access. For this, we really need to completely rethink what a limited liability company or an LLC actually is. Do not just think of an LLC as a standard legal liability shield. Actually, scratch that. Think of it more like a technological API key. It's the legal corporate vehicle that acts as the required bridge to unlock those digital financial layers for foreign residents. And here is the real non-obvious magic of it. This corporate vehicle shifts the massive compliance burden away from you as an individual and places it squarely onto the entity. Without that entity acting as a buffer, those digital gates are staying firmly shut. But with it, the structural problem is totally solved.
So what's the exact playbook here? It's a simple cause and effect sequence. Step 1, remote entity formation. Use infrastructure providers to seamlessly spin up the LLC in a business-friendly jurisdiction. Easy enough. Step 2 is acquiring your federal identification number. This 9-digit code is essentially the corporate equivalent of a domestic ID, and it is the most critical piece of the whole puzzle. Now, keep in mind, for non-residents without domestic social security numbers, getting this code often means dealing with a manual, paper-based process with tax authorities. It's not always instant, and honestly, it can severely delay your launch if you don't manage it right. Then, finally, step 3, digital platform approval. With the entity legally formed and that federal ID in hand, the system officially recognizes you. You can now pass those biometric and digital compliance checks on the modern platforms.
Which brings us to part 3, categorization and optimization.
Once you have the keys, you're stepping into a pretty confusing landscape of financial tools. We need to categorize these accurately so you can optimize your day-to-day operations. Let's break the ecosystem down into 3 distinct tiers. Tier 1, those are your legacy institutions, actual chartered banks that are really only best for local, physical, brick-and-mortar businesses. Tier 2 consists of digital platforms. These are software layers built specifically for remote operating and accounting. These are game changers because they offer granular, multi-user access.
You can give a bookkeeper read-only access without handing them the keys to the vault. Plus, you can instantly spin up dozens of virtual cards. Legacy banks fail miserably at this. And finally, Tier 3, transfer agents. These are currency exchange platforms optimized purely for cross-border payouts. Picking the wrong tier for your main operations will absolutely cripple your efficiency.
We really need to clear up a massive misconception right now. Tier 2 digital platforms, they are rarely actual banks themselves. They are highly sophisticated software layers, basically user interfaces built directly on top of traditional Tier 1 partner banks. We call this the sponsor bank model. The Tier 1 bank holds the heavy regulatory license and the actual capital, but let's be real, their remote user experience is usually terrible. The Tier 2 software layer swoops in to provide the seamless remote access, the sleek interface, and the vital integrations that global founders actually need. And there's a huge non-obvious bonus here: sweep networks. These digital layers automatically sweep your capital into multiple underlying chartered banks, which maximizes your deposit insurance limits way beyond standard thresholds. For a startup with funding, that is the ultimate sleep-at-night security.
So why are we obsessing over picking the right tier? Because of the massive second-order effects it has on your operations. Tier 2 digital platforms offer these seamless API integrations with standard accounting software. When your operating capital flows through a Tier 2 platform, your transactions are automatically categorized. Automated receipt matching and direct integrations literally turn your financial stack from a historical reporting nightmare into a real-time operational dashboard. It drastically reduces end-of-year reporting friction. That means you can actually monitor your runway and burn rate accurately and spend your time scaling the business instead of manually untangling a chaotic ledger.
But on the flip side, look at what happens if you try to use Tier 3 transfer agents as your main operating account. Yes, they're great for moving money across borders, but their ledgers lack the necessary context for business accounting. Why? Because transfer agents aggregate funds and usually process them via local payout networks rather than traditional wire systems. This strips away all that crucial metadata that accountants rely on. It becomes incredibly difficult to track specific payment purposes, and they absolutely do not import cleanly into your accounting software. If you run your primary revenue through a transfer agent, you are virtually guaranteeing a painful manual reconciliation process at year-end. You have to treat them as specific tools, not as your main hub.
Let's shift gears a bit. Part 4, evaluating the proxy risk.
I want you to really internalize this expert consensus. Using a third-party manager means you are not managing the account. Someone else has access to your funds. Because legacy Tier 1 banks strictly require a physical presence, some founders try this dangerous workaround. They hire a domestic proxy, a third-party manager, to literally physically walk into a branch and open the account on their behalf. You have to ask yourself, does the perceived safety of a big legacy bank name really justify handing over the literal keys to your corporate treasury to a proxy? No way. Listen, going this route means you suffer a complete loss of direct fund control. You become dangerously reliant on external signature authority. Your entire operational capital is now highly dependent on the integrity of a third party. And ultimately, this exposes your business to unnecessary corporate hijacking. Just think about the absolute legal nightmare of trying to reclaim your funds across international borders when the person who has physical signature authority at that legacy bank branch just decides to freeze you out. It's catastrophic. Contrast that with the secure, biometric, remote admin control of Tier 2 digital platforms. The proxy route is a massive risk taken simply to access a Tier 1 institution, completely ignoring the fact that Tier 2 digital layers solve this exact problem legally, securely, and 100% remotely. All right, bringing it home with Part 5, Global Transfer Architecture. Now that we understand the mechanisms, the tiers, and the risks, let's look at how to design the optimal capital flow. This matrix right here illustrates the strategic separation you need for a flawless global operation. Your main digital account, that Tier 2 platform, acts as your centralized hub. Its main function is capital holding and accounting. The strategy? Keep it totally safe from high-risk flags. Then you use a Tier 3 transfer agent purely for vendor and employee payouts. Its function is isolated cross-border currency exchange.
Let's say you need to pay 5 contractors in 5 different countries. Instead of sending 5 separate, wildly expensive international wires directly from your main hub, you execute one single bulk domestic transfer over to your Tier 3 agent. The agent then distributes the funds using local payment rails. You only fund the Tier 3 account from your Tier 2 hub exactly when you need to. And this is arguably the most paramount actionable insight of this entire explainer. If you send dozens of small cross-border payments in various currencies directly from your main Tier 2 operating account, you are going to trip internal compliance algorithms. Why? Because modern digital banks rely heavily on automated anti-money laundering, or AML algorithms. High-velocity, diverse cross-border payments look exactly like money laundering to an AI model. This triggers automatic freezes that can lock up your operational capital for weeks, often with zero human customer support available to help you out. You mitigate this severe risk by strictly isolating those international payouts. Keep your primary operational capital centralized, clean, and completely separated from the high-friction mechanics of global currency exchange. So, to tie it all together, use a legal entity as your API key. Establish a digital Tier 2 hub for your primary capital, and strictly isolate your payouts through a Tier 3 agent. By leveraging remote corporate entities to access these digital layers while strategically isolating high-risk transfers, you bypass legacy friction entirely. Which leaves us with this final provocative thought. As these digital software layers continue to evolve and completely abstract away the legacy banking system, what will the next phase of truly borderless corporate infrastructure actually look like? Something to think about. Thank you so much for joining me for today's explainer. Keep learning and keep building.